When buying index funds or ETFs, you'll often be hit with fees such as trading fees or account management fees, but these aren't the only costs that you'll need to worry about when investing. There's also taxes, and quite a few of them. Now, if you live in the UK, you can avoid many investment-related taxes via a stocks and shares ISA. You're entitled to put up to £20,000 into a stocks and shares ISA every single year at the time of recording. You just can't exceed the overall ISA limits. These limits are subject to change, but they're correct at the time of recording. Inside a stocks and shares ISA, any returns you make are 100% yours, so you won't need to pay any capital gains tax on your profits, and you won't pay any dividends tax on dividends you receive. You will technically still have other taxes to pay, such as withholding taxes when receiving dividends from US companies, although this is taken at source, so you won't actually see the tax being paid. And there are a variety of other taxes and fees that you technically don't avoid, so we'll be covering those in this video. There are also other tax-efficient accounts like SIPs, but those have a few more ins and outs to understand. We do have a full video explaining SIPs and the tax benefits of using one, which I will link in the description below. Regardless of whether you're using a tax-efficient account or not, there are various taxes that you need to know about when investing, so we'll go through them now. Capital gains tax is the first thing to be wary of, as if you're not investing efficiently, this can affect your potential returns massively. Currently, this is a big moneymaker for the government, as reports suggest it will raise £15.2 billion in 2024 to 2025, which equates to roughly £530 per household. But what actually is it, and how could it affect your investments? Well, as the name might suggest, capital gains tax is tax that you pay on any investment returns that you make. For example, say you invested £10,000 within a tax year and by the end of it that £10,000 was now worth £20,000 and you cashed out, you would be taxed on the additional £10,000 you made during that time period, minus the annual capital gains limit, which isn't very large these days. In previous years, you had quite a bit of leeway here, as you used to be entitled to earn up to £12,300 in capital gains returns before you'd have to pay any tax. But in the upcoming 2024-25 tax year, you're now set to only have a tax-free allowance of £3,000 before you need to start paying up. So in our example, where you earned £10,000 in returns, you would not pay any tax on £3,000 worth of that, only on the remaining £7,000. But when it comes to what you'll actually pay in capital gains tax, that all depends on your tax bracket. So if you're in the basic rate, you will need to pay 18% tax, then if you're a higher or additional rate taxpayer, you will need to pay 24%. Again, just for clarity, you can avoid capital gains tax from your stock market investments entirely if you invest inside a tax-efficient account like a stocks and shares ISA. Another tax you'll often need to pay when investing is dividend tax, which won't come as too much of a surprise, has also seen limits be dramatically decreased in recent years. While in 2016 you could earn £5,000 in dividends before paying any tax, as of the 2024-25 tax year, you will now only be able to earn £500 tax-free. The amount you'll pay in tax on your dividend income again depends on your tax bracket when factoring in your total income from salary, dividends and other sources, with the basic rate paying 8.75%, the higher rate paying 33.75% and the additional rate paying 39.35%. You can contact HMRC to have your tax code changed, meaning that this tax can be taken from your salary or pension, or you can fill out a self-assessment report, but just to be clear, if you earned less than £500 in dividends within the tax year, you do not need to inform HMRC about it at all. And if you invest inside a stocks and shares ISA, you avoid dividend tax completely. If you were to invest into individual UK stocks and shares, you would need to pay stamp duty tax on each transaction, which is 0.5%. Meaning if you bought £1,000 worth of shares in a UK stock, you'd pay £5 in tax. When investing into index funds or ETFs, you won't be required to pay this tax, but that doesn't mean that you don't need to worry about it entirely. You see, the fund managers could potentially need to pay this tax if they're buying UK stocks, and this will affect the management fee that you pay for investing into that fund. So be sure to do your own research so you know exactly what you're paying. Another tax that might seem a little bit depressing, but is a major one, is inheritance tax. This is something you might potentially have to pay if you die. Well, not you, but whoever receives your estate. The first £325,000 is tax-free, but anything over that you will have to pay inheritance tax on, and that includes your investments into index funds or ETFs. And the really bad news is that this even includes your stocks and shares ISA. Your profits in ISAs are mostly tax-free while you're still alive, but if you do pass away, they will be subject to tax unfortunately. And the amount of tax owed will depend on the value of your portfolio at the close of the day that you passed on. There is a way to get around this. You can gift your investments to your loved ones, but just be warned, at least 7 years need to pass before you die after gifting this in order for the inheritance tax to be avoided. If you're either married or in a civil partnership, your partner can inherit your investments without paying any tax. But for further advice and guidance on this, I do recommend you speak with a qualified financial advisor or an accountant. As well as taxes, there are other fees that you should be aware of. So if you want to learn about all of the potential fees attached to index funds and ETFs, you can watch the video that I've put on screen for you now.